Hi, and welcome back to Channel 11. I'm Ken Shinoda, your host. Today is Tuesday, September 3rd. Coming back after Labor Day, have special guest Jeff Sherman, Deputy CIO. Thanks for joining us. We're going to cover some macro. We're going to spice it up. And this August review is called The Rate Cuts Are Coming.
Yeah.
And we've got Jerome Powell here is Paul Revere, and he's riding out to tell everyone the rate cuts are coming. And then we got the Land of Gains rocket ship behind him. That's the markets are enjoying these rate cuts, and we'll talk about maybe the markets are pricing in too many cuts, potentially.
Yeah, I mean, it's what we've all been waiting for 2024, as Jay set it off last November, right? And what we've seen is now we're kind of back to that euphoria. The rate cuts are here. The no landing scenarios is kind of the narrative once again. And so I think that's why it makes sense today. Let's look at the macroeconomic landscape and see what that all means.
Sure. So one of the things that has been driving the concept of rate cuts has been that macroeconomic data has been surprising to the downside. Here we have kind of global city surprise indices, US, EM, China, Euro area, everything surprising to the downside. Until very recently, we've seen a little bit of uptick, but I think this is one of the big drivers of why we've seen rates come down, right?
Yeah, but I like to juxtapose this against the 23 experience, right? So if you look at the black line there, notice that throughout the entire period of 2023, where it was the most forecasted recession ever, right? If you recall, everybody was calling for that, or at least consensus was. And then look at the data surprised the upside. And just like markets tend to do, by the time people change their expectations a little bit and get used to this better data, then the data starts to disappoint a little bit. So it's important not just to look at the what's happened, the surprise, but also look at how you're setting the economic table. And I think when you look at some of those aggregate kind of economic indicators outside of like the LEI, you'll see that the data is pretty constant right now. So I think it's, what we're seeing is that we were overshooting in 23. Where the expectations got set a little better, but we're kind of back on trend. And you see that with the GDP data, for instance, right? If you look at it, we're kind of back to that trend line growth once again, after all the excesses kind of got worked off through all the money printing of 20 and 2021.
Yep. This morning, we just got the new ISM numbers. I think it came out slightly better than last month. I'm not sure it's up. Actually, this might have the updated data in it. Manufacturing continues to be weak, obviously. But services, outside of a blip where we dropped below 50 for a couple months, seems like the consumer's still been spending, right?
Yeah, and we'll get the service data later in the week. Kind of if you look at that ISM today on the manufacturing, the employment was a little weak inside of there. The prices paid was again a little bit elevated too. So you're kind of getting that kind of a little weakening in manufacturing employment, but also strong in prices paid, and thus it's kind of a little inflationary pressure on the manufacturing sector. But again, I wouldn't read too much into that at this stage because again, it's all about the services. I think services are roughly like 85% of the overall economy, and that's why that chart is so important and why we focus more on the service data than the manufacturing.
Yeah, earlier this year, we talked about one of the potential upside risks to inflation was global manufacturing reaccelerates, but it seems like that risk has kind of declined. Looks like Germany's going into a recession. Chinese growth has slowed down.
Yeah.
So U.S. manufacturing kind of remains weak. So I feel like that risk has decreased.
Yeah, you saw the German IFO data, but also if you look at commodity prices, right? So I think, I can't remember the last time that we talked on this show. Obviously, we talk a lot. But if you think about it, we had that commodity price boom that was going on like March, April, May, where it's very Chinese-centric commodities. And those things have reversed outside of gold, which obviously gold doesn't really impact the manufacturing segment as much. But I do think that you're seeing some of that. And so, again, I think that's also why the rate cuts are coming.
Yep. Well, let's talk about inflation. It's come down pretty meaningfully throughout the year, which is why we're talking about rate cuts. But maybe it'll go sideways for a while. I mean, it seems like, but the Fed has kind of moved away from the inflation narrative, and now it's all about jobs.
Yeah, if you look at it too, we got that blip up in a little bit of services there through the core services. Like shelter was really driving that down. You can see shelters kind of decelerating and getting that lagged effect with rents and the like. But notice what's really driving this headline inflation down is the goods deflation. Now, I think, when you ask the average person, are you enjoying your goods deflation? They'll say, what, the prices have stayed the same. So a lot of that tends to be adjustments in there. But you're finding that all that stress that we had in the system, from the supply chains from 3 years ago has finally worked out, and you're seeing it across the board. So this is a reason to celebrate. Again, goods typically don't give you much inflation. Look at your chart, Ken. That dark blue area, over the last decade, it's been very rare that's been additive to overall CPI. So I'd say the aberration was that supply chain shock, and you've seen that completely reverse itself. Although prices will not come down, right?
Yeah, I just bought a new car for my wife, and it wasn't as crazy as it was 2-3 years ago, where everything was trading like, way above MSRP and food fight for stuff.
Yeah, right, exactly.
Here we got Supercore and PCE. Supercore a little bit stickier up there, but I think as the labor market continues to get a little bit weaker, you should see some moderation there as well.
Yeah, and I mean, this metric is essentially irrelevant now, right?
Yeah.
I mean, this was the thing that Jay touted out. He trolled this out to say, okay, look, this is improving because the shelter side wasn't. And he hasn't really talked about this really in most of his speeches this year, because look at the data. It hasn't been supportive of that. So I think that's going to be one of the series that will retire in 2024 is this concept of supercore inflation.
Let's move on to jobs, because that seems to be what had really driven markets. We got that weak payroll number in early August that everyone said, emergency rate cuts now, please, right?
Yeah, right.
Kind of freaked out a little bit, but
it's funny, stocks drop over 2 trading days, and all of a sudden,
emergency rate cuts.
Yeah, we need to have emergency rates 75. I heard some people out there calling for 100. It's like, but we created jobs. It was just a little bit weaker, and then since then we've seen the revisions. It's not in this data set, the revisions, because it is survey data. I think it comes out in early 2025 when they release the full report. That's when you'll see adjustments downward. But you still see, even if you adjust for that 800,000+ that came out of the labor market just due to the survey data, you still have a big mismatch here. There's about 3 million differences in jobs between the household and the establishment survey. So again, I don't think it's the collapse of job growth at this stage. It's a little bit weaker. But if you think back, prior to the pandemic, we would celebrate having 120 to 150,000 jobs per month, right?
Yep.
And so the idea is just we were delivering these high 200s, high 300,000 per month. And again, it's a little bit overstated, as we've since seen. But in general, I think what you see with the labor market is that, again, the spending's there. You're seeing the consumer be there, and until you really see a meaningful uptick in really layoffs, I think that the economy continues to go. But I think what people have focused on was that unemployment number out of that report.
SOM rule, yeah.
Yeah. And so, the SOM rule got triggered, but even Claudia Sahm came on TV and said, well, maybe it's a little different because of some of the noise in the data set. So we'll just have to see. I mean, it's what economics is. It's trying to put together your best guess. And right now, it's all about the labor market. And I think that's why you're seeing this kind of, there's more balance in the labor market. Thus, Jay's talking about cuts. That's what he said, that the time has come.
Yep.
So there's the unemployment rate, right? That's what we talked about there. And, usually when you see an uptick of, historically, it's been 50 basis points off the low. The SOM rule's a little bit different, some moving averages in there, but it's a very similar concept. That's usually what gets triggered for the recession. So you have to be on watch here. But again, is it, the household data is right? Is it the establishment survey is right? That's the biggest challenge we see. But yeah, Ken, what I like to look at with all of this is starting to look at unemployment claims, because my contention always is that if you lose your job, there's no shame in going to the unemployment office and getting that check, right? You just got to fill this out. We all pay into it. And so that's something that we've seen a lot more stability in versus the unemployment rate.
Some also argue that some people may not be filing for unemployment because they go to part-time jobs or driving Ubers or delivery, things like that.
Yeah.
And maybe that's one of the reasons some of the old data we look at isn't as useful.
That's true, but if they're working, right? So that's the whole concept there, and so it should show up in the labor data too.
Jobs are jobs.
Jobs are jobs, and so at the end of the day, it's about making those ends meet, right?
Yeah, it's funny when people argue, oh, well, it was only government jobs that drove the job growth. Like, somebody's getting paid, they're spending money, right?
I mean, I hear that from Jim Bianco all the time. He's like, if you have a job and you're making money, you will spend money. Does not matter how you generate that income. Now, granted, there may not be a great money multiplier and all the things we want for GDP growth.
Yep.
But at the end of the day, as you said, a job is a job, and a paycheck's a paycheck. And so there's your unemployment claims. You can see there's some stability there in that line. But I'm really looking at the continuing claims, which is that.
It's been creeping up.
Yeah, it's crept up. But if you took this back, what you'd see, if you went back prior to the pandemic, this is roughly kind of where that balance is in the labor market of having this level of kind of continuing claims out there. So again, only time will tell whether or not
But this is what the Fed wants, right? The Fed wants the balance to come back where it'll take the pressure off the wage growth that's going to drive that services inflation?
Well, a lot of it is we lost people during the pandemic. Unfortunately, there was death, right? But there was a lot of migration out of the country as well. And so we lost a lot of people that didn't come back to the labor force. And so that's what you're seeing. It takes time. You can't just create jobs and say, welcome back to America, especially when the visa programs are so difficult. And so I think it just takes some time. And you're right. This is why they're seeing balance. And remember, the Fed has the Phillips curve, which says the unemployment rate is correlated to, unemployment rate is correlated to the inflation rate because of that wage growth component. So this is what they're looking for.
More normalization, job openings coming down. There was a little bit of surprise to the upside, I think, in the last one. So we get that Wednesday, right? We get the jobs. So that's something else to watch. And here's that wage growth making its way down. This is, I think, more important now than some of the inflation data is going to be all this job data, the wage data.
Yeah, I think the inflation kind of story is somewhat behind us. Now, granted, I think there's going to be some noise in it. It probably doesn't moderate exactly at 2%, where the Fed's extremely comfortable, but it's going to be all about the labor market. And the Atlanta Fed had paused releasing this data for a couple months, and so I'm glad to see it's back now. But they made some adjustments to their time series. But you see there that, again, they both kind of move in the same direction here. And again, this is the highest level of wage growth we've seen really in the last 20 years, right? And so in general, even though we've had that inflation, if we can keep wages kind of moderating at these levels and that growth rate, and let's say inflation sub 3, then ultimately people are making progress, which is the key to kind of growing the overall economy.
Yep. Savings rate's been coming down. People dipping into savings to maintain consumption, which is why we continue to see positive retail sales.
Yeah, and also remember, this is the savings rates as a percentage of disposable income. So this doesn't mean you're drawing down the savings. We're just saving less as society. And some of the contentions has been what this is because, hey, look, I've made money on my house. I made money on the stock market. I've been able to generate some other kind of returns. And so we don't have to save as much, right? They're seeing those balances grow. And so potentially they're spending more of their disposable income, but because they have the land of gains in their equity portfolios, right? That you're growing that nest egg that way. So as long as markets are cooperative, a low savings rate does not connote that something is extremely negative in the overall economy.
Yeah, this is like a spot rate, right? It's like each paycheck you get. So
yeah, how much do you save?
What about all the cash and savings and money markets now that's earning something, right?
That's right. That's right.
Almost, it's like saving as well, right?
It is. It's the same thing. And so yeah, you maybe as a percentage, and that's why you got to look at the denominator effect too. Like if your asset base is growing too, you maybe don't need to save as much of that paycheck. Now it's great to get in the habit of always doing that. So we'd advise everyone to do, right? But in general, I think that's part of some of what you're seeing out there.
Some of the alarmists out there always point to increasing delinquencies. They're kind of just normalizing, and not surprisingly, worse credit borrowers with lower FICO scores. We don't have that on this page, but they kind of are deteriorating the most, and it makes sense. We're basically back to kind of like pre-COVID levels. We had a sharp drop in delinquencies because people got stimulus checks, so now we're coming back into, I think, kind of normalization with the broader macro data too, right?
Right. Well, you say it's alarmist, but the weaker credits are the ones that are weak, right? Isn't that the definition of weaker credits usually, right?
Yeah.
When you have a low FICO, usually you have some history of missing something. But also they tend to be the lower income strata as well. So they're hit the hardest by the inflation, right? Because inflation's regressive. So as you said, it's more of a normalization across the delinquencies. And so, again, we've been looking at this for like 18 months now, saying it's rising, it's rising, it's rising. But thus far, it hasn't caused a big ripple effect in the overall economy.
Small business optimism picking up a little bit.
Yeah, I wonder if this is some of the rate cut kind of behavior. I really don't think most small businesses know the rate cut cycle, that it's coming too, but maybe they're seeing lower borrowing rates out there. And so potentially maybe they're getting better access to credit as well too. But this has been kind of the choke point. If you look at the chart there, you can see that really when the Fed started hiking, right? Because again, most small businesses borrow at a prime rate.
Yeah.
Well, it's tied to, Fed funds, and that's what the Fed's controlling. So we've seen this huge kind of increase in borrowing costs there. And so if you kind of look at that optimism, I bet if you looked at the, kind of Fed fund policy, you would see it to be inversely correlated here.
Yep.
And so potentially that's somewhat's going on. And it could just be also, again, just the economic environment has changed because there's that better balance of workers in the overall economy.
Unemployment rate inverted and small business hiring plans. Small business hiring plans have been dropping a lot. They tend to not want to borrow and expand their businesses when rates are so high. So maybe this starts turning around with rates coming down as well.
Yeah,
But this has been good for the labor market. I mean, it's one of those signs that shows that the hiring is cooling and the demand is cooling.
That's right. And if you think about, I mean, just anecdotally, and again, you can't extrapolate anecdotes, but if you kind of look at smaller business, you look at restaurants, we've seen them survive, right? Locally, around the LA basin and everything, you see them surviving, but there isn't that expansion.
Yeah.
Because CapEx is expensive. You borrow double digits. So it makes sense that you see some cooling. But this is what monetary policy tightening is supposed to do, right?
Yeah.
It's having its impact on the overall economy. But this is why the Fed wants to slow things down. They want to bring rates down, not be as restricted, because they don't want this to dip down into kind of those recessionary indicator levels.
All right, well, let's move on to markets. With the moderating growth and inflation, it's finally seeing some strong returns for fixed income. This is just the month of August. You can see a high quality fixed income up about 1%, the floating rate stuff lagging, obviously, being floating rate. So the index, the ag index, up 1.4% just in the month of August, which now takes it year to date 2024 to about 3%. But credit still has been the place to be. The riskier the credit, the better. Yeah. You can see triple C levered loans up almost 10%. CMBS, which was a big laggard last year, the triple Bs are up 15%. So,
what's amazing about those triple C loans, that's just coupon, by the way.
Totally. The price is kind of unchanged.
The price is unchanged. That's just the carry on the trade too there too. But look at that non-agency CMBS, the triple Bs there. I mean, just how strong that performance was. Where everybody's calling for the end of the world in commercial mortgages, and we were kind of out there last year and adding to those positions. Not as much in the triple Bs, but a little bit in the higher quality single A's and above. But in general, it's been a great place to be. But the easy money's been made, and I know you talk to our colleague Morris Chen and his team all the time on the commercial side, and some of this price behavior's got a little ahead of itself, we think, from that fundamental perspective. But look, fixed income returns have been good this year, but this is what happens when you start with a nice yield, right? And so again, we've had a little rate rally as of late that's helped out, but in general, a lot of that is just coupon.
So here's looking across the curve, going out back to, this is 10 years. And yes, we've had a rally, but still in the big scheme of things, rates are high and yields are attractive.
We're back where we were. That's where we started the year.
Yeah, I mean,
roughly,
outside
right?
of the 2-year, right? the rest of the curve is basically unchanged from the beginning of the year. I think we started at like 385 on the 10-year. Here we're at 388 or something today.
Right. Yeah. So I mean, it's just not much difference. So again, it's coupon at the end of the day. I mean, that's why you buy yield as an investor, is you get the yield. So
we think we've run a little bit too far, too fast. We've shortened our duration in some of our portfolios. Here you can see kind of monster rally that started in April and continues. So we've taken our duration down a little bit. From a tactical standpoint, that's really kind of short term. Long term, don't get too cute.
Yeah.
If you've been sitting in T-bill and chill for like the last 12, 24 months, probably worth coming out the curve a little bit.
Yeah, exactly. Now, even after this rally, even with those treasury yields you see on there, a high quality credit portfolio mixed with some of this, you can still get in the 5.5 kind of range, which that's comparable to T-bills, but it also has the ability to generate a greater return if something kind of calamitous happens in the overall economy. But also, remember that rate's coming down at some point as the Fed cuts. But you said too far, too fast. And I saw some data from Deutsche Bank showing that outside of something, and I use the word calamitous again, happening in the market, the Fed typically does not cut 50 in the first cut in the cycle.
Yeah.
So the 25 is more normal. And so this idea that we're going to get these large cuts, I think the Fed wants to be patient still. They don't want to get egg in their face. They don't want inflation to come back. They don't want expectations to change. And so, again, looking at that forward curve and just, again, we have so many cuts priced in. I know we have a chart on it that it just looks a little strange. So cue the chart. You're good at this, Ken. But you can see here where we are today at that 498. That's essentially a little over a cut, maybe a cut and a half is kind of priced in 2 weeks' time. But notice what's happened in the curve. We're kind of back to where we were in January. And so one thing that, I was talking to the team about recently was, look, if you go back to January, we had 200 basis points of cuts priced in over 1 year. Well, guess what we have today? 200 basis points of cuts priced in 1 year. But guess what? Rates haven't been cut yet, right? Yeah. So just because the forward curve has this expectation doesn't mean that those always materialize. And so That was part of our thesis in kind of shortening duration a little bit, was that, maybe the Fed's not as generous in the cuts as the market wants. And to get to those levels, you got to have a couple 50s along the way. There's only 8 meetings a year, right? So as you look through it, it gets a little tough. So I think if you look at that kind of through summer pricing, I think it's June of next year, you see that's essentially 200 basis points a cut. So I don't know. It feels a little aggressive to me.
Yeah, you would need the jobs data to weaken meaningfully for them to go that aggressive.
Meaningfully, I think meaningfully. So, and we have to see some degradation elsewhere. So again, so as you said, it's a tactical trade. It's not that we think there's something wrong with rates. They're going back to those kind of cycle highs. But again, that's our job as being active, is to try to make a couple.
Yeah, we say short, and we're still about 5.5 years, which is not short, right?
Correct. Right. Yeah. Exactly.
Let's go back a couple slides. Finally, almost uninverted on the 2s, 10s. We were the longest inversion ever.
Yeah. At least in the I don't know if it's post World War II, or at least since the 80s for sure. But this isn't an all clear signal. Historically, when the curve has uninverted, it tends to lead to a recession at some point. But I think it's what's the catalyst behind that. And again, if the Fed gets ahead of this enough in the kind of cutting cycle, maybe the belly of the curve needs to be roughly where it is. Maybe it comes down a little bit, but that 2's pricing comes down because of the Fed cuts. So we'll have to see how this all plays out. But definitely, it's not reason to celebrate typically, or at least using historical data, when the curve uninverts.
Here are changes in spreads on the month and on the year. Let's look at the year, which is in the black, and you can see some of the sectors that rallied last year just didn't have as much upside. So one of the things we've been talking about a lot is that the securitized markets lagged the corporate credit markets. And so you can see IGs, down a little bit. But what's down the most is a lot of these securitized sectors, ABS, CLOs, CMBS, in what we've been calling the catch-up trade. And one of the charts we've looked at a lot is this comparison of the securitized spreads relative to IG. And the only reason these lines haven't moved down more aggressively is, IG's done pretty well still.
Yeah, no, I mean, look, it's a high quality asset no matter what one says about the issuance. I think I saw today that there's going to be like 25 deals coming out today in the IG market, or maybe it's this week. It could be a lot for a day. It's 25 this week, but that's going to put some pressure on the market too, just because corporates come out with this rate rally. You see everyone clamoring to try to refinance some of this debt. And it brings me back to that inversion comment too. We'd look at the 2s, 10s. But remember, if you look at the 3-month T-bill versus a 10-year, there's still a meaningful inversion here. So that means the Fed has a lot of leeway to cut. So even though people use the 2s, 10s, some use the T-bill versus that. But what you're seeing is with that bond rally and even the notes on the 2-year side, it's bringing people into the market to issue, especially with an election in 65 days or so. Since it's Tuesday, I guess it's got to be 63. It's got to be a multiple of 7. But if you take a look at what's happening, is that there's just this deluge of supply coming to the market. And so that's kind of another thing on the tactical trade on duration. Look, just because it's corporate bonds doesn't mean it won't put pressure on rates overall. So in general, we like the catch-up trades. They've worked out quite well this year. And we haven't really peeled this off, right? I mean,
as you can see on the chart, there's room to run. And one of the things I was talking to Morris Chen, who runs CMBS, about was if people wake up and want to buy, there's just not enough issuance. Unlike corporate bonds that you mentioned have tons of issuance, there's limited issuance in some of these markets. And that demand, one of the reasons the spreads are wider is because these are mostly actively managed bond fund managers that target these sectors. They've been seeing outflows. If all of a sudden we see inflows again, there's going to be this rush to buy, and you'll see these spreads kind of ratchet back in.
Right, and we're talking about a corporate bond market that issues, sometimes $100 billion in a month, and the CMBS market had stress last month because there was an announcement of like $5 billion coming to the market, and everybody freaked out about, can it absorb?
Yeah, there's like one corporate bond deal will be $5 billion.
Right, exactly.
Right. So, all right, well, let's move away from bonds to currencies here. You can see the dollar's near the weakest of the year, which makes sense because we're going to finally cut rates.
Yeah, and if you take it back, look at your chart here. We are right back where we started the year. So, I mean, it just followed the rate path too. And so you use this, I believe this is a 10-year you have on here. You could use a 2-year. You can use kind of that forward curve to kind of do it, because that's really how the currency market moves. But again, if you look at it, it's not surprising here. And so To me, this doesn't portend something horrible. A lot of the alarmists will come and say, oh, look at the decline in the dollar. It's the deficit. It's all the spending. It's the government's fault. But I kind of see a pretty strong relationship there.
Well, it's also still pretty strong. I mean, relative to other currencies out there.
Yeah, the one it's the weakest to is gold, probably, right? Gold's had a killer run this year. And again, that's probably some other reasons out there. There's a lot of geopolitical risk. But you turn into commodities here and look at commodities had their little limelight, when we talked about that China reflation trade, all the, copper, nickels, and you also saw gold at the time going up well. Well, look, we finally got above the average just in time to bait people back in to bring it back down. And so if you look lately, look, we've got crude oil today trading in the low 70s. It's good. By the way, oil prices being lower are good in general for the consumer. That translates to lower gasoline prices, which help people, which give them more disposable income. So these are things that are, you don't want to see a commodity price spike, for a consumer that may be on the cusp of weakening. So all these things can be more constructive to allow people to spend. By the way, don't forget, retail sales has gasoline in it. It's not just going out and buying, discretionary items. When you look at retail, fuel pump prices are one of them as well.
Short term, there's been some pain. Long term, asset allocation.
Look, I still like it for the reason that, look, if we're going into recession, it's going to be a problem. I don't like it under that scenario. But if we start to have that recession, I think you saw the playbook last time that if we're going to print money, we're going to put it in the system. And we had this coordinated central bank policy, at least in a developed world, we have for the last 15 years. Why won't they do the same thing again? So I think the playbook on commodities is to be patient for now. Again, you're never going to get it exactly right. You could get these little spikes where people thought, look, we're having a recession in 24, but commodity prices did quite well. So again, they are very pro-cyclical. So you got to be careful with that, but definitely they belong in a strategic asset allocation portfolio.
Yeah, Bank of America's Michael Hartnett was out talking about looking at it in a world of higher inflation, it would be additive to the portfolios.
Yeah, and look, we still have stress on commodities too. Again, it's something about the term structure and things, but if you have limited supply at times, which happens because they get underinvested in, even if the prices don't move, you can actually make money on those ideas just because of the shape of the curve. So again, from a strategic standpoint, it's good, but it doesn't compete with the stock market. That's just been a killer run.
The land of gains with our land of gains rocket ship. It's been smiley face for almost the entire year. There was like a brief moment of sad face. And
that was the emergency 75 basis point cut 2 days.
Here we are back at almost all-time highs on the S&P 500. And looking across sectors, positive across the board. The Dow finally playing catch up more recently. Even small caps having played catch up too. So
it's kind of interesting to see actually the S&P ahead of the NASDAQ now, right? Because again, you think of it as being a tech-driven rally, right? And the NASDAQ 100 and everything in there. But if you look at the overall composite, it's actually a little bit weaker than the S&P. I don't think anyone's going to argue over 70 basis points there.
Yeah, it seems some of the high flyer like Mag 7 stuff has gotten weaker, and then there's been catch up. So like the equal weighted, I think hit an all-time high very recently. But look at these returns; it's just pretty remarkable.
Yeah, across the board. And so you've just seen a lot of the catch-up trades too. But there's also that momentum, and look at that. If you're a factor investor, the momentum has just been super strong, and that's what index investing is, right? It's a momentum-based strategy, and so it's worked very well. Again, if you look at the revenue growth, it's been concentrated in like 5 or 6 names this year, and so it's not shocking to see that continues. But again, from an overall asset allocation standpoint, it does make sense to look at other things. From our standpoint, the equally weighted portfolios make a lot of sense here. In fact, when you compare it and look at the volatility, there's been meaningfully less volatility in those equally weighted. So actually, when you start to adjust for kind of Sharpe ratios or return per unit of risk, the equally weighted portfolios have done quite well this year.
Yeah. Some charts we looked at maybe last month or 2 months ago on Tech It to the Limit. Didn't get as many hits for Tech It to the Limit. We weren't bearish enough. We should have been more bearish. It seems like the more bearish your title, the more clicks we get.
Well, we're talking about a revolution today. Rate cuts are coming. The rate cuts are coming.
But you can see that you saw a pretty meaningful correction out of the Mag 7. It's obviously played catch up. But some of the stuff that was lagging, doing well now, that equal weighted.
That Mag 7 chart still looks bad. When I look at that, right? We got back up, you kind of retrace. It's like a Fibonacci retracement. But then you look here, we've rolled over again, even with kind of where rates are over the last couple of weeks, right? Rates are a little bit lower the last couple of weeks. So it's kind of shocking. But look at the volatility numbers on that chart there. And you can see that the S&P X Mag 7, I saw someone over the weekend call it the lag 493. So the Mag 7, the lag 493. But look at the vol there. So it's just interesting to see that all this concentration being those names, that is what's driving overall volatility as well. So again, as an investor who can be patient, right, and you want to have more stable, volatility is not usually your friend, unless you're a trader and you're really trying to day trade it. And you can see the rest of the market is kind of way more contained than you see in these kind of high flying names, usually by definition.
Yeah, makes sense. Here's another one, I think. So it must have been July when we had Tech It to the Limit, because this was near an all-time high, and we've seen a correction there with.
Maybe you're a contrarian signal with your titles.
I try not to be too negative, you know.
Right.
Bond guys are always so negative, so.
Yeah, well, we don't get the landing gains; we get par back, you know, when we do well. And
unlimited upside in stocks.
But look at that. I mean, just look at the tech world, the tech equal weighted, right? But this just shows that mega cap dominance there, and it continues to drive everything.
Here's another one that had hit a all-time high since 2000, which was that NASDAQ versus basically growth versus value, right?
Yep. Yeah, and look, the thing is here for the Russell 2000 is that these are smaller companies, right? They have higher borrowing costs. They don't have this access to the upper end of the IG corporate bond market, right? So they're paying higher rates. And so I think you need some of this to help fuel it. You need rates to come down. You need borrowing costs to be better for these companies. Now, the question is, do you want to own this going into the cutting cycle? Well, I think it's all a function of how fast does the Fed cut. Yeah. And so, again, the Russell 2, it's definitely underperformed. Everything's underperformed, kind of the tech sector of the NASDAQ composite. So it's just one of those things where when the reversals come, they can happen. Again, I don't think you were trying to say we're going to repeat the 2000 experience here, but it's just showing the
extreme valuation.
Extreme valuations. Yeah.
Yeah. All right. Well, that was the Land of Gains review, and thanks for coming on. Hope everyone found this informative, and we'll catch up next month on Channel 11.
Thanks for having me, Ken.